Hi, I'm Sameer Jain, and the conversation today is what are some of the more helpful regulations that have affected financial services recently. So the financial sector is a lot safer today with much stronger regulation and supervision, and this is a clear path to ending the too big to fail conundrum. The regulatory system should be efficient and not inhibit lending to households and businesses, provided of course that risks are being priced and managed correctly. Regulators and supervisors should make sure that bank staff are doing their job, but they should not try to take over those jobs. So some examples that stand out for me is, if you look at the pre-crisis problem, the largest banks had far too little capital, and the solution has been increased capital requirements, which has led to sharply increased capital and resilience. The pre-crisis problem of bailout or instability that led to bailout or instability. So a major problem was that policymakers were faced with the choice of either bailing out large institutions or just letting them go under, with of course very serious consequences for financial stability. And the solution, the Dodd-Frank Act, as implemented by the FDIC. So banks seem to have created a buffer of equity and long-term unsecured debt at the holding company level. And in the event of a failure, the holding company is lifted off while the subsidiaries are placed into a new company, call it a bridge company, and remain in operation. The other pre-crisis problem was consumer financial protection took a back seat. So a bifurcated regulatory authority, limited regulatory will, and a lack of legal authority to regulate non-bank consumer products has led to substandard consumer protections, and consumers were abused in the mortgage, credit card, small dollar lending markets. And the solution to that has been consolidation of consumer protection in one agency with expanded jurisdiction, and this has created a much more level playing field. So the Consumer Financial Protection Bureau, CFPB, was created with a single motion to focus on consumer protection, and authority was realigned and expanded to cover most major consumer products. Independent funding was secured along with very competent senior leadership. The CFPB has quickly established itself as a major financial regulator in tackling a range of critical issues. So it is hard to think of any new federal regulatory agency that has had as much impact in its first few years. And of course, this is being undermined in this administration. Another pre-crisis problem that comes to my mind is unregulated derivatives markets with trading by large financial institutions. So the solution has been mandatory clearing. Many derivatives must now use central clearing now. The Volcker rule, banks are prohibited from engaging in proprietary trading or owning hedge funds or private equity funds. And the purpose is to reduce speculation by banks and to eliminate conflicts of interest between banks' profits and the interests of their customers. That seems to have worked. The Lincoln Amendment ensured banks push out their swaps businesses to non-bank affiliates that are not eligible for deposit insurance or access to the Fed's discount window. The intent has been to protect taxpayer funds by barring them from being used to help firms that may have gotten into trouble due to swaps trading. So all of these have made our financial system much safer. And that's why I think one needs to look at it through a longer lens, 6 years, 7 years, 8 years. And I have a feeling that with lax regulation, what's happening right now, a lot of these things are getting reversed. So I'm not a great fan of deregulation, but that's just a personal view. Thank you so much for listening in. Bye-bye.